Stocks push higher with the BSE Sensex scaling to 80,000 for the first time ever. Financials and healthcare are the big gainers, even as IT and energy drag.
HDFC Bank perks up after it reports a foreign holding of below 55%, which creates room for passive buying by MSCI Emerging Market Index tracking funds. IIFL Securities estimates these inflows to be anywhere to the tune of $3 to $4 billion.
Federal Bank gains on strong growth in deposits and advances, and MOIL jumps in posting its highest quarterly sales. But Mahindra Finance skids on weak business momentum and a dip in asset quality.
Brent oil prices scale to $87 per barrel as US inventories dip amid growing summer demand. Hurricane Beryl only adds fuel to the fire as it nears the Gulf of Mexico. Good afternoon. You're watching us here on Halftime Report. I'm Manglam Malu. With me, Sonal. We're seeing a big move in the markets. Today, it's led by the Nifty Bank, which is almost 1,000 points higher, a fresh record high for all the frontline indices. Most importantly, the Sensex, the grand old index, hitting that 80,000 mark high.
Yeah, hey Manglam, you know, it's like just a while back we were talking about that 30,000 mark, celebrating it on air.
Yeah.
Then we reached that 60,000 mark, and here we are at that 80,000 mark. So time really flies, and it's 80,000 on the Sensex, and as you said, it's a grand old index, and a lot of market watchers who've been in the market for a long time, they look at Sensex very closely, right? So it is for that generation who've been investing for years. So definitely a big milestone here.
A big milestone. You know, Nifty is for the cult traders and Sensex is for culture. But, you know, just a trivia question. When you joined CNBC-TV18, do you remember what the Sensex was that time?
I think it had just touched 30,000. I remember the celebrations that happened, and then it fell quickly from those levels. So.
Hopefully soon we'll also look at the Nifty looking at 30,000 at some point in time. But, you know, the big mover in today's trading session clearly has been HDFC Bank. The stock of the day surges after the bank's latest shareholding pattern shows a 55%, the shareholding pattern for foreigners falling below 55%, suggesting headroom for further flows. So we have, that stock which is on our radar. Earlier today, we spoke. Okay, let's go across to Abhishek first and understand what this means. And then we discuss more about HDFC Bank itself. Abhishek.
Well, to begin with, HDFC Bank has released their June 2024 shareholding, wherein the FI holding now is below the 55% level. So, June shareholding indicates that, there are chances that MSCI weight may increase for HDFC Bank. FI shareholding as of June was at 54.83%. Now, FI holding had to fall below 55.5% for MSCI flows. So, HDFC Bank over there is expected to see an inflow of about $3 billion to $4 billion with respect to the headroom they have. FI headroom slipping below 55% creates a headroom of 25% is what analysts are saying. Just to alert our viewers, foreign investment ceiling in HDFC Bank is at 74%. Now, we have a note from IIFL Alternate Research which says that in the August 24 review, they expect the weight to be taken up in a single tranche itself with respect to MSCI, and they expect the stock to gain anywhere between 4 to 6% further in the run-up to the weight up to the event. Back to you.
Okay, all right. That's a big event, and that is the analysis on what's leading to that surge in HDFC Bank stock today. Earlier today, we spoke to Sriram Velayudhan of IIFL Securities, and he says he expects a passive inflow of $3 to $4 billion into the stock. Let's listen into some key excerpts.
So HDFC Bank weight up event has been one of the closely followed events in the Indian markets. So we were expecting this to happen. The foreign room has opened about 25%, and as a result of this, the adjustment factor will be revised from half to 1. This should lead to passive inflows of roughly $2.8 to $3 billion. We anticipate a further up move of 4 to 6% in the name in the run-up to the deval event. In terms of impact, it would be the likes of Reliance, TCS, Infosys and all, which have a higher weight in the index. But in terms of ADV, it should not have that much of an impact because all these are very, very liquid names.
All right, that's about HDFC Bank. But, it's the financials which are in focus today. A whole host of BFSI stocks also on our radar on the back of their first quarter FY25 business updates. Abhishek joins in with a roundup of all of that. M&M Financial is the underperformer out there with a big move in Federal Bank. Abhishek.
Well, to begin with good news, that is Federal Bank, the business momentum is really healthy over there. More than 5% growth and deposit, CASA or advances as well on a sequential basis. So deposit momentum is, healthy over there at 19.6% YOY and about 5.4% sequentially. In absolute value, CASA has grown by 5%, but it's below the overall deposit growth. Hence, you are seeing a slight decline in the CASA ratio, which is at, 36 quarter low of 29.3%. Customer deposits, that's held up really well, growing at 19.8% YOY and about 5% sequentially. Advances growth pretty healthy at 20.1% YOY and about 5.4% sequentially. That's helped the credit deposit ratio improve both YOY and quarter on quarter. Now, M&M Finance, the business update is weak, especially on the growth front. The growth rate continued to decline because the disbursements are on the lower side and asset quality has also deteriorated sharply. Unlike in the last year Q1 FY24, this year the asset quality deterioration is much higher. So let's talk about the disbursements. Monthly disbursements of June is up 2.8% YOY and it's declined by 1.35% month on month. June of 2023 had seen about disbursements momentum to be strong at 13.3% YOY and about 2.4% month on month. Q1 FY25 disbursements are up 4.6% YOY, but they have declined 16.6% quarter on quarter. Collection efficiency has also dipped. It's now down to 95% for the month of June 2024 when you compare to 96% that they had in the previous month as well. So collection efficiency for Q1 FY25 is at 94% versus 98% on a sequential basis. Total asset or business momentum has been at 22.6% YOY and about 3.7% sequentially. Talking about asset quality, that's seen a deterioration. Gross NP ratio is up 20 basis points quarter on quarter, while the stage 2, that is loan dues between 60 days to 90 days, now that's increased massively to 6.1% versus 5% that they had in the previous quarter. Back to you.
Okay, all right. That's all about the financial updates, and that keeps coming in ahead of the earnings season that we are going to talk about very soon. The other update is MOIL. It is surging in trade on the back of its Q1 business update. Nigel is joining us with all the details here. Nigel.
Well, that's right. MOIL, in fact, is higher in today's trading session. And if you look at a broader chart, you'll see that the stock went to around 565 odd, and then it corrected closer to around 15%. So post that correction, the street has read these numbers rather positively in terms of an operational update. It's more or less in line with what the antique analyst was expecting in terms of a production update. Let's run you through the numbers though. The volumes are up by close to around 14.5% for the first quarter on a year-on-year basis, which is good news. And the production number was up by close to around 7.8%. They also go on to say that exploration is up by close to around 49% on a year-on-year basis. So that gives you a bit of visibility for the time ahead. Even after this run-up, how does the valuation stack up? Well, the market cap has now moved to around 10,000 crores approximately. They have around 1,000 crores of cash in books. That means around 10% of the market cap is covered in cash itself. X of the cash, if you look at the EPS estimates, in the past year, they've done EPS estimate of close to around 14 rupees. That, in fact, has increased as per antique estimates to around 25 rupees. And post that, they're expecting it to go to around 39 rupees odd. So on a forward earning basis, that is on FY26, if that EPS can go from around 14 to around 39 rupees per share, then it's trading at around 12 times core business. So the stock is excited in today's trading session. It was relatively much cheaper, around 2 months or so ago when it was at around 380 rupees. But for the time being, the street has read this operational update positively. Good volume growth, pricing has been strong as well, and a favorable balance sheet is what is exciting the street. Back to you.
7.5% higher on MOIL. Thank you so much, Nigel, for joining us with all those details. Well, more Q1 business updates, this time around from Avenue Supermarts. It reported its standalone revenue growth and the other updates as well. Mangalam, tell us more about this.
Well, it's been good for V-Mart. The stock's mildly in the green right now. If you look at, the last 6 months or so, you would see that it's seen a rally of almost 36-37% from its lows already. So a large part of the street was actually factoring in some sort of improvement in operational environment and in the environment itself for Avenue Supermarts. 18% revenue growth is what they've posted, 18.3% to be precise, on a standalone basis year on year. And this is pretty much in line with the 3-year CAGR that they had for Avenue Supermarts revenue itself. So, no further deterioration. In fact, only improvement in consumer sentiment is what we're seeing here. More importantly, they've added about 6 stores during the quarter. And if you look at the store addition year on year, the store addition is close to around 13.5%. So revenue growth of 18%, store addition of 13.5% implies same-store sales growth of anywhere between 5 to 6%, and that's what the street is expecting this time around. The most important thing to watch out for when the numbers of the company would be reported are three. One, what happens to the product mix of the company? Increasingly, we've seen a veering of the product mix towards lower margin products like FMCG and not so much for general merchandise and apparel. So that's something we'll have to watch out for. And as a result of which, the direct impact of that would be on the gross margins of the company. And the third most important thing, remember, these are standalone revenue updates that we've gotten. On the consolidated basis, we'll have the performance of e-commerce or D-Mart Ready as well, which will be reported by the company. So those are a couple of important things to track. And just from a directional standpoint, when we spoke to the management on May 15, the company said that their key goal is adding new stores to the business and looking for moats in the e-commerce business and growing it. And that is something we'll be watching out for going forward as well. But for now, 18% revenue growth is good.
Okay, it is good. So far, it's been decent for all the Q1 updates that we've got, barring some of those BFSI updates. But we'll slip into a short break. When we come back, we'll connect with Anand Agrawal, the CFO of V-Mart, to discuss their Q1 business update and demand outlook. Stay tuned for that.
Well, ahead of the result season, you always have the preview season. We've been talking about how the first quarter preview for a lot of the financials have been, and before going into break, we spoke about D-Mart as well. But let's talk about V-Mart. That stock is abuzz in today's trading session after reporting what was a good set of the first quarter preview update itself. The stock at the high point of trade, remember the company's revenue grew at around 16%, with V-Mart same-store sales growth coming in at 12% for the first quarter as well. Anand Agrawal, who's the CFO of the company, now joins us. Thanks a lot, Anand, for joining in. Always a pleasure speaking with you. The first obvious question is that FY24, the SSSG was just about 1%. The first quarter, SSSG is 12%, so obviously it comes on a low base. What's the target for this entire year?
Thank you, Mangalam. I think we should still be targeting mid to high single digit for the full year. While the first quarter, as you rightly said, might be on a low base, but definitely with the disruptions in elections and also almost zero marriages in the first quarter did not really help us in terms of getting any tailwinds. But definitely we look forward to a much stronger year throughout.
Okay, so, it's low double digits right now that you've seen in terms of SSSG growth. And you said there were certain factors which did not work in your favor. Despite that, you're talking about high single digit growth in FY25. Are you being conservative here? Because it looks like the other quarters could be better than Q1.
Not really, Sonal. I would still want to be cautiously optimistic. I think we've seen a lot of downturn, especially in the rural and the semi-urban space in the last 2-3 years, especially post-COVID. We've seen a lot of consumer behavior getting changed. So we've tried to adapt a bit to that. And I would still want to be cautiously optimistic and make sure that at least we get back to where we were pre-COVID levels in terms of the sales per square feet. So SSG is just one of the metrics which we track. But I think more importantly, we want to increase our throughput at the store level, which obviously should mean that we would want to grow our SSG in high single digit, at least for this year as well as the next year.
You actually anticipated the next question. Then you spoke about SSSG being at high single digits, but that not being the only metric that you track as well. So let's talk about some other metrics. If you could, share how the other internals been during the quarter: product mix, average ticket size, footfalls, any data that you can, share with us that describes consumer sentiment better.
I think we've definitely seen a bit more traction in the consumer footfalls. We've seen slightly better numbers, and also in terms of the number of bills that we cut, we've seen much higher growth there. Particular regions which were not doing so well in the last 1 year, they've started to come back, started to grow. We've also closed a few stores in the last year. We took a hard call on almost 25 stores closure last year. So that's also now behind our back. So that's also slightly helping. Overall, I think in terms of the product portfolio, we have made the product slightly younger. We're trying to reach out to much bigger audience, and especially the youth audience. We've reduced our marketing significantly. We're going more digital. So there are a lot of changes that we've been doing. And especially on the product side, I think we've implemented a full new design team in the last 1.5 years. We've set up a new warehouse in the last 1 year, which has now got operationalized. So internally, I think there's a lot of work which has happened in the last 1.5 years. And I would say almost 30-40% of that has now started to bear fruit. There's still a lot of projects which are underway. There's still a lot of work which is, happening. But yes, everything takes a bit of time. But we're quite hopeful that we should be able to get back to the pre-COVID levels and improve our performance even better.
Okay, take that point. So let's talk about revenues then. A 16% growth this time at 786 crore rupees in Q1. What's the target for FY25? Now that elections are over, we do have monsoons coming up. What's the demand like in Uttar Pradesh, Bihar, Jharkhand, Uttarakhand around monsoon? And what's your take here?
So monsoons are expected to be slightly better this year. It's been a slow start so far, but what the forecast currently suggests, we should have a bountiful monsoon this year. And that should bode well for our key markets of UP, Bihar, West Bengal, Jharkhand. And given the backdrop of last 2 years, while the national average of monsoons was okay, but in the Indo-Gangetic belt, the monsoon deficit was almost like 16%. So hopefully this year it should be much better, and that should also reflect in better purchasing power for our core customers. So far, we have seen good demand coming in from all of these states, UP, Bihar, Jharkhand, and West Bengal. Despite the fact that, it was acute summers, no monsoons, no early onset of monsoon. But yes, we remain hopeful, and, given the spate of how the rains have happened in the last 10 days or so, it definitely looks like that it is going to be a good season this year.
Good season this year. You've spoken about, all the things that are driving the top line this time around, and also a lot of the things that you've done at the back end to improve efficiencies, be it closing stores, having a new warehouse, increasing your, focus towards digital spends, etc. What happens to the margins? Because with all of this coming together, one would assume that margins would grow ahead of revenue, right? What kind of margins are you targeting this year? Because last year you fell back quite sharply.
Yeah. So I am not too optimistic on the margins. We will definitely want to improve on our performance, definitely. But at the same time, I must also highlight that we have also taken some price cuts in the last 2 years. We've also been reducing our average selling prices. So there will definitely be some pressure on the margins. But yes, with some amount of same-store sales growth or reasonable amount of same-store sales growth, there will be some amount of betterment in the margins. Being a value retailer, we would want to push back the maximum value that we can give back to the customer and thereby increase the top line and increase rupee margins rather than increasing the percentage margins. So that's always been our core focus, so that we are able to convince and make sure that our customer repeat buys always with us. And that is something that we will still want to drive. So I will not really commit or comment on too much of margin growth. Also that the inflation has not really been very helpful. But yes, there will be some amount of margin growth versus last year.
Okay, so let's take the margin question forward and the two segments. Just want to understand, when will Unlimited's margins meet that of V-Mart? And also LimeRoad, do we expect it to be a bit positive this year, maybe first half or second half?
So Unlimited has definitely been a turnaround story. We've been seeing good growth in Unlimited. We've also closed a lot of unprofitable stores in Unlimited, and that should start helping, looking at some better numbers coming in from the brand. In terms of how they equate to the core V-Mart business margins, I think that is still at least a year away. But the journey looks quite positive and very, very visible now. As we are opening more number of new stores in South India under Unlimited brand, we are able to get similar level of margins, especially in the new stores. So it's just a matter of time before the the average margins for the entire chain becomes almost equal to V-Mart. As far as LimeRoad is concerned, we've been stressing a lot in terms of making sure that fits in very nicely in the omnification of the entire group's offline business. That's where the key focus lies. And I think there's still a lot of work to do there. We should not be able to probably look at profitability in that business before next year. Would not really want to comment on, exit the year at profitability. But yes, we will be reducing our losses on that business quarter on quarter, like we have been doing for the last 3 quarters. And going forward also, we should see reduction in losses every quarter. It's a very small business. It's a very, less than 2% of our business, so not really material.
All right, take that point. Just one thing, you said there would be improvement in margins even if you're not very optimistic. Last year was 7.5% versus 11% in the previous quarter. Do you have an aspiration to be around high single digits or perhaps double digits? Just trying to understand that. Your own aspiration here.
No, aspiration will always be to, be in high, at least in double digits, but really can't comment at this stage what the full year number is going to look like.
Okay, all right. Mr. Agrawal, thank you so much for joining us today and speaking with us with the outlook going forward. That's the word coming in from V-Mart Retail. They expect high single-digit SSSG growth in this fiscal itself and some idea about the demand trends in different geographies as well. Time for a break. Pritesh Mehta of Yes Securities joins us on the show with some trading strategies on the other side. Stay tuned.
Welcome back. You're watching us here on Halftime Report. It's a 150-point move that we're seeing on the Nifty right now. Some updates coming in from ABB India, where their Pixel Paint technology has been selected by M&M for its new EV paint facility. So a new client coming in for ABB India, increased business, and that means increased performance on the stock price as well. It spiked a little at the high point of trade. But with the 150-point gain that we're seeing on the Nifty, if you just take a look at the tug-of war that is underway between Nifty Bank and Nifty IT. Yesterday, we were speaking about how the IT index was doing a lot better and lifting the weight on its shoulders. So the Nifty, when the Nifty Bank was lower, but now today, the IT index is actually lower with the Nifty Bank being higher, and it's HDFC Bank that has been the top contributor to both the Nifty as well as the Nifty Bank. So you have the contribution chart for both, the Nifty and the Nifty Bank coming up for you on the screen, and you would see that this near 3% up move that we're seeing on HDFC Bank has meant that it has been contributed. It's contributed more than 50% of the gains that we're seeing on the Nifty. It's got 12% weight out there. And the Nifty Bank, that one comes up for you as well, where you see a big move. But where does HDFC Bank grow from here right now? The 1800 call has maximum open interest. So levels upwards of 1820 would see some stiff resistance. But at the same time, the 1780 put is extremely active as well. So levels where we are right now, closer to 1770 thereabouts, would see some strong support as well. So it's this very narrow range that the street is looking at as well. For the Nifty Bank, the 53,000 mark was extremely crucial this morning because that had the maximum call writing out there. But once it went past that, there was short covering at the 53,000 call, and the 53,000 put writers have seen maximum open interest. But levels upwards of 53,200 continue to face some supply on the Nifty Bank, especially from an expiry standpoint, because 53,200 call writers are equally active as well. Where does that lead the Nifty to? So you have the 24,200 put writers very active at around 50 rupees a pop. That means that 24,150 would be an important support at the lower end for the Nifty. And on the way up, however, the 24,300 call writers equally active for a 50 rupee premium as well. So 24,150 to closer to 24,350 is the range that we're looking for on the Nifty. Remember, it's the Nifty weekly options expiry tomorrow as well. In terms of stocks, a lot of short positions being added on Ashok Leyland, and at the same time, we're seeing a lot of long positions being added on ICICI Lombard as well as Axis Bank. So those are a couple of stocks that I'll keep on my radar.
Okay, and these two stocks doing well as well. There's a CLSA note as well on ICICI Lombard. They've raised the target price there. But let's get in Pritesh Mehta, Senior VP Research, Yes Securities, joining us now. Pritesh, good afternoon. Thank you so much for joining us. Well, what are the next levels to watch out for on the Nifty and any individual trades that you have for us?
Yes, good afternoon. I think we should not be concerned with the upside potential of the index. See, a market is driven momentum. Whenever a market which is driven momentum takes control of the proceedings, numbers are, we should not focus more on numbers because it can be breached on the upside. See, we have seen financials taking the lead 2 weeks back, and the last 2 days we had IT doing well. Today, HDFC Bank is driving the markets higher. So different pockets are participating in the market, which is a good sign. My breadth is impressive. My Nifty breadth is impressive. It is reversing off lows. So there is strength, there is momentum in the market. So I think focusing on the upside, target with the right approach, I think we should participate in the rally. As far as the number is concerned, I think 24,600 should be the upside target, at least in the near term. But I think focusing on the stocks would be the right way to play this market. And since we're talking about the stocks, we have created one customized insurance index, and one stock that we like from this space is SBI Life. The stock has been, underperformed recently, but it has come up sharply. We are witnessing a bullish turtle breakout, and I'm expecting the stock to rally to 1650. The stock would be around 1470 from here on. The second stock that we like is for the PSC basket. PSC basket came off slightly, came up the last few days, but from here on, I'm expecting strong move coming in. We already seen a bullish ABC breakout, and our target was 335 possible.
Okay, all right. Thank you so much, Pritesh, for joining us with that take. Let's slip into a short break. When we come back, we'll get you more on the markets and also put focus on ICICI Lombard, PFC and REC. They all are buzzing in trade today. Welcome back. You're still tuned into Halftime Report. Well, of course, the star of the day today is Bank Nifty, but there's a lot of action that continues in the broader markets as well. Castrol India, for instance, is up 9% in trade as we speak. There's been a one-way move on this one. Remember, the peer Gulf Oil Lubricants has been doing well, and Castrol is catching up here now. Zydus Wellness is the other one, which is up 7% in trade right now. We have Wockhardt after that announcement of that new drug that they were developing on Friday. It has seen a one-way move since then, and there's another 7% rise on that stock today. There you go. Wockhardt has recovered sharply from the lows as well. Some of these packaging names, Cosmo First, Ester Industries, Polyplex, all of them are buzzing in trade. We'll have to figure out what is happening with the spreads there because they've been under pressure. But whether demand is coming back or not is something that we'll check with the managements as well. But this is a pocket which is doing really well. Ester Industries, Polyplex, the other players in the packaging market as well. But let's talk about some brokerage action as well because ICICI Lombard, PFC, REC are buzzing in trade on the back of fresh brokerage calls. Sudarshan is joining us with the key highlights. Sudarshan.
So there is another positive note coming in for ICICI Lombard after Jefferies CLSA has upgraded the stock to outperform from hold and target is raised to rupees 2,000 from 1,760 per share. It says company's April-May motor insurance premium growth was at 31% versus industry's growth of 15%. And worsening of peers' motor third-party loss ratio is leading them to curtail growth, and premiumization of cars and benefits from Motor Vehicle Act may aid the motor book. It has raised overall premium growth estimate by 2% for FY25 and believes momentum in the motor book could persist further. On PFC and REC, Bernstein has initiated coverage with buy call and target for REC is rupees 653 and for PFC it's 620 per share. It says both these companies are amongst most preferred plays in power cycle and investors are underestimating duration and intensity of this power cycle, and NPA risk for both PFC and REC is much lower in this cycle. On the valuation front, it says it's still cheap despite the run both these companies have seen in the last 1 to 2 years.
All right, Sudarshan, thanks a lot for that. That's about REC and PFC, both these stocks among top F&O gainers in today's trading session. But let's take a short break, and as we do that, here's something very important. While SMEs are pivotal to the nation's economic growth, what are the key factors driving their journey to success? CNBC-TV18 has dedicatedly owned up to empowering and celebrating these small and medium enterprises, highlighting their achievements and contributions to the economy with HSBC presents CNBC-TV18 SME Champion Awards. And today, we put the spotlight on the inspiring journey of Freer Energy Services, a company that not only contributes to economic growth, but also champions sustainability. So let's discover how their innovative approaches and strategic partnerships are shaping a brighter and more sustainable future. That's Freer Energies. Welcome back. A couple of stocks from the cash markets which are spiking. We have Cosmo First, which is up around 7% Soam Distilleries is the other one, which is up 4%. A big move is what we're seeing in a couple of these, QSR space names. So Sapphire, for instance, has moved higher. And also something like Imami continues to rally. In fact, this year so far, the stock is up 32%. And in the last 12 months, if you look at Imami, the stock is up around almost 75%. A lot of things coming together for this company. But that's about the secondary market. Let's talk about the primary markets. We have a steel wiring company, Bansal Wire Industries, 750 crore IPO open today. Earlier today, we spoke with Arun Gupta, who's the chairman and whole-time director of the company. Pranav Bansal, who's the managing director and CEO of the company as well. Let's listen in to the excerpt of this conversation. And thereafter, we'll listen in to what the other IPO, Emcure Pharma, the management of that, had to say.
we are coming with a 745 CR IPO, out of which 560, around 560 will be repaid against the old debt, which will satisfy almost maximum debt what we have, and balance money we will use, because we are a growing company, we will use for a working capital from there on.
We are very happy with where we are, with the kind of margin profile that we have today, because we believe our return on our investments are quite okay. Going forward as well, because the kind of products that we make, we consider it to be a backbone of any industry in India today. Therefore, we are still relying, and we will heavily bank on these product mix. We are today almost at full capacity. For the last 2 years, we've been at peak capacity utilization, with 2.5 lakh tons of our full capacity being there. But now, and only this year, we've started production in the 5th facility of ours, which, as I said, is India's largest and one of the largest fire facilities there is in Asia. And that facility standalone has a capacity of 3.5 lakh tons. So basically, what I'm trying to tell you is that from 2.5, we are jumping to 6 lakh tons of capacity.
Even Emcure Pharma's 1952 crore IPO has opened for subscription today. Earlier today, we spoke with company's MD and CEO, Satish Mehta. He tells us that 48% revenue is coming from domestic business, and they talk about the outlook going forward as well. Let's listen into excerpt of that conversation.
48% is being given by domestic contributor, 52% comes through from export. I would like the ratio by and large, will remain same, but I wish, as far as the domestic is concerned, it tilts, towards domestic. I'll be happy if domestic is 53, 54, 55, and as far as the exports are concerned, that is, 45, 50 or whatever it is. So we do around 45% in chronic and 55% in acute. Obviously, as far as chronic is concerned, the margins are better, and company will keep on, focusing on that. That as far as the 1,000 medical representatives that we have added, it takes time, to reach the productivity, desired productivity. So as we increase the productivity, that should also have a positive impact, on the EBITDA and margins that we have.
Okay, all right. Time for a break now. On the other side, Manisha Gupta joins us with Shyam Narsaria, President, Overseas Agro Trader Association, Myanmar. Stay tuned for that conversation.
Welcome back, and joining us on the show now is Shyam Narsaria. He's President, Overseas Agro Trader Association at Myanmar. Mr. Narsaria, hi, thank you so much for joining us. And the topic of conversation clearly is pulses, where India really seems to be tackling that one for the last 18, 20 months, but with little results, while we have seen various actions being taken to ensure that this is one area of inflation which can somehow be brought under control. I want to talk about the kind of imports that India seems to be doing from Myanmar, which is an important country, trade partner as well when it comes to pulses. What are the kind of numbers that we're looking at for the quarter gone by?
Thank you, Manisha ji. Myanmar has been consistently exporting mainly black market and two-hole to India, and the numbers are quite good. Means like 3 years, the average is around 50,000 tons per month for black market and 18,000 metric tons per month for two-hole. But during the past 6 months, Myanmar has exported 65,000 tons on average of black market and 31,000 per month of two-hole, which is 50% more than the average for the past 3 years, and also 50% more than the last year same period. So as far as the numbers are concerned, Myanmar is exporting very well. It's a good support to India to tackle the inflation. And for the coming 6 months also, I believe we have sufficient number of black market, around 400 to 450,000 tons, which is a good number. Again, we can export at the same rate of 60 to 65,000 tons per month. For two-hole, yes, we have a limited stock, around 1 lakh tons is available. So I think around 15 to 20,000 tons per month will be available for export.
So, Mr. Narsaria, just to get the point right, that Myanmar is exporting these couple of pulses to India 50% higher than what we've seen in last 3 years average?
Correct.
Okay. And do you see that sustaining with the kind of push that India has in sense of self-sufficiency? Perhaps we'll hear something in the budget as well. How are you looking at this number going forward?
The self-sufficiency, I believe, as we see the monsoon, this year the monsoon is 8 days earlier, almost it reached entire India. And as per the last sowing data which I received on 28th of June, India, especially the pulses sowing of Kharif, Turhol and Slack Mafte, the percentage is 32% more compared to the last year. So I do believe, yes, India will be able to, not 100%, but at least 85 to 90% will achieve the self-sufficiency. And rest for the balance, especially pigeon peas, have to depend on overseas market like Myanmar and Africa. For black mafte, yes, the dependency is 100% in Myanmar for the shortage. And Myanmar is also having a good number of, say, 8 to 9 lakh tons. So I believe India production will go up this year, but still need to import some quantity, say 4 or 5 lakh tons from Myanmar.
Point taken. How are you also looking at the kind of restrictions that Indian government has put for a couple of these pulses in sense of stock disclosures, etc.? Do you see India getting away from that anytime soon?
I don't see in the near future, unless there is a big number in the production for the coming Kharif crop, there is any change. But I do believe that last India took 3-4 major steps which are very good for the industry, especially like the increase the MSP last month, which is a very healthy sign. And as a result, as I mentioned, the sowing is 32% more. And then India then imposed the stock limit, which is again a welcome sign. I appreciate the effort because that will tackle somehow the price. And it has, means like 5 rupee per kg has come down after that. And the stock limit is successful, we can say. For the coming, say, 6 months, I don't see any further policy changes will be there regarding to this pulses. Because the target of the government is almost achieved. They are able to bring down the prices almost not 100% control level. It's too far from the MSP. Like for pigeon peas, the MSP is around 75-50, but the current market prices are 115. Wide difference, 40 rupee difference. But still, next month, if Africa crop starts for pigeon peas, I think the prices will be down. And same for black mafte. Like next 2 months, there will be India crop. The sowing numbers are very promising. But we have to see the monsoon, how it behaves in the month of August when the flower comes. If there is a extra rain, that will be a problem. But if the way monsoon is going now, if everything goes well, there will be no shortage of this kind of pulses.
Of course, Mr. Nasaria, as you said, everything depends on monsoon and the sowing numbers, and we'll get a clarity of that by mid-July, perhaps 20th of July. We'll have to see the monsoons until then as well. There have been various concerns about not just hoarding within India, but in the past about hoarding at the origin as well. Would you say all of that perhaps has been sorted by now?
Actually, there is no hoarding either in India also and in origin, say Myanmar. I'm from Myanmar, so I say in Myanmar there is no hoarding. I have a proof. I have numbers to prove. As I mentioned, that we are exporting 50% more than the average. And by 6 months, we have exported almost more than half of the quantity, almost 65 to 70% we have exported out of Myanmar. So where is the hoarding? So whatever impression the trade has that the origin is hoarding is not correct. Even I believe in India, there is no hoarding. Yes, the millers are holding. That is up to their installed capacity, say 30 to 40% they were holding. That is not holding. That they need to maintain the stock. So I don't believe there is a holding anywhere.
Okay, all right. Thank you, Manisha, for that discussion. Thank you, Mr. Nasaria, for joining us with your take. That's our commodity segment. With that, we'll wrap on this edition of Halftime Report with the news that the Nifty is up 162 points. Sensex again very close to that 80,000 mark. Mid-caps continue to do well and Bank Nifty is outperforming. We'll take your leave, but do stay tuned. Business Lunch will take all the action ahead.